Hi, this is PR Sundar. Welcome to this special episode where I'm going to discuss a very good strategy, very low risk strategy, and the reward is also not going to be high. So the risk is proportional to the reward, or the reward is proportional to the risk. So you want to take a high risk, you may get a high return, but when the risk comes, you lose more. But when you go for a low risk, the return will also be low, the risk will also be low. So today I'm going to discuss one such strategy. So before discussing the strategy, let me tell you what most people do. As soon as they see me, sir, you please tell me what share to buy. If somebody seeing Monday, I also ask the same question. Somebody see Tuesday, also ask the same question. Somebody see Wednesday, also ask the same question. You know what the people think, anytime they come, anytime they ask me, so I have to give them a share and that share should do well. And that is practically not possible. So whenever people ask me, even in many media interviews also I stated, okay, the best way to invest, don't chase the bus. Wait for the bus to stop. Sometimes even the bus may go for a breakdown. That time we can enter into the bus. So stock market, if it keeps on moving higher and higher, maybe the traders can capture the momentum. But as an investor, you must wait for a correction to enter into the market. So first, what is the meaning of the word correction? A correction means a benchmark index like Nifty falling more than 10%. That is called correction. What is a bear market? A benchmark index like Nifty falling more than 20% is called bear market. So market can correct 10%, 20%, it can correct even 30%, 40%, 50%. But if you look at the history of Indian stock market, the Nifty has corrected more than 50% only once, that was during Lehman Brothers collapse. Second time the Nifty fell, the maximum was 40%, that was during coronavirus. The third time the Nifty fell, about 30%, it was in 2004. But uniformly, all these periods, the Nifty has recovered uniformly more than 100% in next 1 or 2 years. Coronavirus, the recent one example I'm giving you, Nifty was trading around 12,000, it went down to 7,500, but within next 1-2 years, it shot up to 15,000. So therefore, you wait for the correction to enter. Then, if you wait for the correction and enter, does it mean that guarantee you will make profit? Not necessary. After falling 10% you buy, it has the potential to fall another 10% also. So therefore, what I always say, if the markets fall more than 10%, I'm talking about the Nifty, not the individual stocks. So maybe you can enter, 50% of your capital you can put it, and then remaining 50% of the capital, put it in FD or some debt mutual funds. If the markets fall more than 20%, then you close that FD and then put it into the market, then wait patiently for next 1 year or 2 years, you are likely to get a very good return. But however, there are so many things which are easy to say but difficult to do it. Now Nifty has gone to 26,300, now it has come to 23,500, so it's a more than 10% correction. So let us say you invest half of your capital. Now if the Nifty falls another 10%, you will be losing 10% of your capital. Some people, especially people with large capital, somebody putting it 10 crore, 1 crore loss also is very big for them. So how the psychology will work? The second thing, even after falling 20%, or even after you put the entire capital, there is not necessary that a 20% fall, then immediately it has to recover. So it can fall another 5-10% also. Possibility is there. So therefore, what mostly ultra HNI clients will try to do, they'll try to hedge their portfolio. So first, let me explain what is the meaning of hedging. Let us say I'm a working professional and based on my salary only my family runs, and if anything happens to me, my family will be in trouble. So what I do, I go and take some insurance. So I have to pay some money to the insurance company, but I don't mind losing that money. But if something happens to me, so my family will get a good lump sum money to survive. So that is called hedging. If something happens to you, somewhere there is a loss, somewhere there must be a gain. The same way, once you invest in a stock market, the market can fall. If the market can fall, you can be in trouble. But if the market falls, so you should get some money from somewhere else, some benefit from somewhere else. And that is the hedging. But again, you want to do that hedging is not going to be free of cost. You can't insure your life at free of cost. You have to pay some money. So that money we must be prepared to pay. So now I will show you in the computer a few things. Okay, if you look here, NSE site, the Nifty is trading around 25,300. 23,500. It went up to 26,300. Now it has fallen nearly about 3,000 points. So there is something called Nifty Bees, Nippon India Nifty Bees, which is trading around 264 rupees. So if you buy 100 Nifty Bees, that is equivalent to 1 Nifty. But again, if you buy 100 this become around 26,000. It means if you divide this 23,500 divided by 100, it should be 235 only. But Nifty Bees will not be trading at 235, they will be trading around 265. There will be a 30 rupees premium. For people who don't understand, my simple answer is that when you buy also, you buy at 30 point higher, and when you sell also, you are going to sell at 30 point higher only. So it's hardly going to make any difference for you, right? But for those who know a little bit, Nifty is a benchmark index, the average of 50 shares. Okay, every year these companies give the dividend, so the dividend is not taken into account. Whereas the Nifty Bees is called total return index. So all those dividend is being added into this. So that's why this is trading around 30, because Nifty has been in existence since 1995 to 2024, about 30 years. Every year about 1 percentage point dividend will be there, so that will be factored in. But again, we don't know when this Nifty Bees started. Probably not started in 1995, maybe from when they started, so they're adding the dividend. So let us forget about it. So you buy 1000 Nifty Bees is equal to 1 Nifty. Now, so you can consider buying this because the market has fallen more than 10%. Another 10% fall, you can look to average and then you wait patiently. But of course, how about the hedging? So first let me tell you, the hedging is not possible for very, very small players. Now, if you want to do the hedging, you have to do the hedging through options. But nowadays, because the SEBI wants to bring down the speculation in stock market, so they increase the lot size of Nifty to 75. Earlier the lot size was 25, now the lot size is 75. So 75 means 75 into 23,500, that's roughly about 18-20 lakhs. So that means if you buy the Nifty Bees only for about 18 to 20 lakhs, that is equivalent to 75 Nifty, then only you can do the hedging in the options market. Otherwise, you cannot do the hedging. So that's number one. That's a big negative point, not suitable for very, very small people. Okay. Second thing, how to do the hedging. So assume that you have bought Nifty Bees equivalent to 75 Nifty. That is 75 into 23,500. Okay. So what you do, you go look at the option chain. In the option chain, look at the next year December. and look at their put option and 24,000 put option. Okay, so first let me explain the basics. There are something called put option and there's something called call option. If you buy a put option, as the market keeps going down and down, you will make profit. If you buy a call option, as and when the market keeps going higher and higher, you will be making profit. So now you have already bought the Nifty. So if the market goes down, you will lose money. So here in option, what you have to do, you have to buy a put option. So that if market goes down, your portfolio will go down, but your buy option will give profit. If the market goes up, your buy option will give loss, but your portfolio will do well. Now, if you buy a 24,000 put option, so which is trading around 880 rupees, right? So 880 rupees, will translate into roughly about 3.5% of your capital. So you already buy Nifty Bees for about 20 lakhs. So another 3.5%, that means about 70,000 you may have to put into this one. The advantage is that, assume that end of this year Nifty goes to 12, end of next year Nifty goes to 20,000. So you bought 23,500, now go to 20,000, so you lose 3,500 rupees, but you will gain 400 rupees here in the options. So, on net you will be making 500 rupees profit. But however, you are paying this 880 rupees from your pocket. So this is not coming free for you, right? So if you factor in this 880, that means your maximum loss is only about 380 rupees. So that will be roughly about 1.5% of your capital. So which means that you buy Nifty Bees, okay, equivalent to 75 shares of Nifty, and then you buy 124,000 put option. If the market crashes for one or the other reason, the maximum money you lose is only 1.5%. You are not going to lose any more than 1.5%. That's a fantastic thing, right? So sometimes, even buy a stock in one day, it goes by 5%, 10% down. But here, no matter how much market goes down, you are not going to lose more than 1.5% of your capital. However, if the market goes higher, assume that market go to 30,000. You bought a 23,500, market go to 30,000. So you are making about 6,500 rupees profit. But the entire 6,500 rupees profit is not yours because you are paying 880 rupees for the hedging. So that will go to zero, right? So if you pay 10,000 rupees to the insurance, then you live happily, nothing happens to you, then the money, that 10,000 you pay to the insurance is gone, right? So your total net worth will be reduced by 10,000. The same way here, your total profit will be reduced by 880 rupees because this 800 rupees, 80 rupees you pay for the insurance has gone to zero. But that you don't mind because, when the market crashes, how much it crashes, you are not going to lose more than 1.5%. Market goes higher, so you will get less profit of 880 rupees. Of course, here there are so many other permutations and combinations, So there are ways I devise the strategies, where even if market goes down, you make zero profit, or market goes up, you capture the entire profit. So they're all like, how to say, so they're all like the strategies, right? So the strategies, we create a lot of strategies. So those strategies we discuss in our workshop. Of course, we cannot give everything free in the YouTube. Then who will attend our workshop because we are charging so much money for workshop. Okay. So in a nutshell, I've given a strategy with a very, very low risk. Maximum you can lose is only 1.5%, but the gain can be, whatever is the gain, minus 880 rupees. Okay, this one thing. Second thing, so, like in our workshop, we always discuss about, how we start with this, then, how we can improve this, we discuss so many improvements. But just one improvement I'll discuss with you now. Okay. See, Nifty Bees will give the same return as a Nifty exactly. But however, instead of putting in a Nifty Bees, if you go and invest your money in some large cap mutual funds, See some large cap mutual funds, right? So they've given better return. 1 year they've given 30%, 3-year average return 15%. Till date, since the starting, it has given average of 16%, So, instead of Nifty Bees, you can invest in some large cap mutual funds. So, which are slightly to give better, like you say, if Nifty gives about 10% return, so this may give 13 or 14% return, 2 to 4% outperformance this will do. That outperformance is what you are paying for your hedging. So that means, no need to worry about the downside. You can only enjoy the upside of the Nifty, right? So this is just one improvement we am discussing. So there are n number of improvements, we discuss. Okay, just 1 second. Okay, I just forgot to show you. So here I am showing the large cap mutual funds. Okay, ICICI Prudential Blue Chip Fund, which has given 15% CAGR for last 3 years, 1 year return 30%, till date 16%, and so on. So this is just one improvement we are, one idea I am giving. So you get some extra return, that extra return you pay for the hedging, so you can make money peacefully. So in our workshop, we discuss a number of strategies like this, but however, at this point of time, of course, whatever you do, the people always criticize. But the many people, they do one criticism, sir, you are not helping the poor people, you are only helping the rich people. So what can I do? I'm running a company which is making an aeroplane. I can only sell it to the people with rich people only. Sir, you are not helping poor people. So can an aeroplane company can come and sell for poor people? Okay, you pay me 5,000 rupees, I give you aeroplane. Okay, even if I give aeroplane, you need a runway. Where is the runway for you? So as I told you here, you want to do hedging, right? You can do hedging only through options. And that option, the lot size is 75 from November 20, right? So that means you need a minimum investment of 20 lakhs. Then how can I teach people with the poor people, right? So the drawback in this, is not suitable for very, very small people. So that's why in our workshop also, so we tell people, very small investors, people with very small capital, please don't come and attend our workshop. Our workshop is only for the people who have at least 25 lakh rupees capital. So that is why we also charge a higher fees. We charge about 50,000 rupees plus GST. So whereas, we can't, just for the sake of helping, like not everybody can help poor people. Okay, can you go and tell the same thing? Mercedes-Benz. Why Mercedes-Benz? You only sell the car for rich people. Why don't you sell for poor people? That is not the way things work, right? So there are certain businesses is suitable for certain people with certain capital. So option selling or hedging is all for people with higher capital. So that's it for now.